Hey everyone, FinTech here. Michael Burry was made famous by The Big Short, and he is correctly called every last major stock market crash. He successfully shorted the dot-com bubble in the early 2000s. He famously predicted and profited from the subprime mortgage crash that kickstarted the Great Recession. And more recently, he's made a fortune off the GameStop meme and shorting Cathie Wood's ARK Innovation ETF in 2021. Needless to say, this guy is a certified genius. And Michael Burry has issued a warning that we face the mother of all crashes in the near future, selling most of his US stocks. This same opinion has been echoed by many publications in recent months, and with the market currently at an average PE ratio of nearly 30, which is nearly double the average price it's seen over the past 100 years, there could be some numbers to support this. So in this video, we're going to look at exactly why Michael Burry is predicting a stock market crash and talk about what actions you can take to maximize your stock market returns in 2022, whether or not the crash ends up happening. But let's start out by hearing out what Michael Burry is actually saying. Burry first gained a large public profile after his portrayal in the movie The Big Short by Christian Bale, and he used that profile to share his thoughts on investing with his large Twitter audience. But unlike a lot of people who voice their opinions on Twitter, he actually backs up his ideas by putting huge amounts of his own money on the line, which famously made him a fortune when he correctly predicted the subprime mortgage crash, putting his entire fund on the line in a bet against the real estate market, putting even Wall Street Bet's YOLOers to shame. This earned him personally around $100 million and another $700 million for investors in his fund when the real estate market did end up collapsing in 2008. More recently, in 2019, he became an early investor in GameStop and wrote several letters to the company's leadership about the company's then wasted potential. This helped lay the groundwork for what would eventually happen on Wall Street Bets, with large numbers of retail investors causing short squeezes in a battle against institutional short sellers of the stock. Burry personally profited around $100 million from his investment in GameStop, though he sold well before the stock hit its all-time high at nearly 5 times his own exit point. But Burry was never one to hold back when he thought an investment was overvalued, and he's not holding back now. Which leads us into his latest position, which may be his biggest bet yet against the market. He has recently come out publicly against many popular investments. After several tweets at the end of 2020 and the beginning of 2021 taunting Tesla investors about how overvalued the EV company was, Burry reportedly had over 8,000 puts against the company, covering the equivalent of 800,000 shares, basically betting the stock price will go down. He was also not shy about voicing his concerns with stocks such as GameStop or the SPACs being overvalued, so companies like SoFi or Virgin Galactic. He also owned put options against celebrity investor Cathie Wood's ARK Innovation ETF, and branched out into calling out Bitcoin, Dogecoin, Robinhood, and even the stock market in general. Then, in April 2021, he deleted his Twitter profile and went silent for a little over a month, before he got back on Twitter and started tweeting once again. In June 2021, he let everyone know that he was shorting US Treasury bonds, and he also sent this message. People always ask me what is going on in the markets. It is simple. Greatest speculative bubble of all time in all things, by 2 orders of magnitude. This sums up basically what Burry had been saying for months. Everything from Bitcoin to SPACs to Tesla to growth stocks to US Treasury bonds were all headed for a crash, and he was willing to lay down money to bet on it. His short position just against US Treasuries was reportedly worth $280 million in August of 2021. But that bet has cost him in recent months. His fund, Scion Asset Management, is down 4.8% for the year at $20.5 billion, while the S&P 500 has run up 25% in that same time. And he ended up selling the put options against both Tesla and the ARK Innovation ETF, essentially giving up on his bearish position. But what's even stranger is how this change in Michael Burry's position ties back to his reason for betting against the stock market in the first place. So what drove Burry to put all this money in a bet against treasury bonds, traditionally one of the most stable investments a person could make? What was Burry seeing in the market back in mid-2021? Well, essentially, Burry's bet is that as lockdowns end and people are free to start spending money, and with a bunch of pent-up money supply from the stimulus checks, we are going to start seeing a much greater amount of inflation than we've seen in recent years. You see, with US Treasury bonds, the price of the bond is inversely related to its yield. So when inflation goes up, so do interest rates and bond yields, and so the price of a bond drops. And also the reverse. When the yield drops, the treasury prices go up. And based on recent data from the CPI, or Consumer Price Index, Burry's position may be starting to come true. The CPI is used to track inflation, and it includes all kinds of different areas of the economy, from used cars to eggs to gasoline for our vehicles. And the CPI has risen by 6.2% over the past 12 months, which generally indicates that we are starting to see much greater inflation than we have in recent years, though some investors like Cathie would disagree. But treasuries aren't the only type of investment that is affected by inflation. In fact, all investments are in some way or another. If the US dollar devalues during inflation, Bitcoin or gold could be targeted by the government as a competitor to their currency, resulting in new regulations coming out that could drive their value down. Growth stocks that are heavily reliant on borrowing money to grow could face troubles as their interest rates on their loans become more and more expensive. And on top of all this pressure from inflation, Burry claims the type of assets he is tweeting about are being driven by a speculative fervor, especially Bitcoin, EV stocks, software as a service stocks, and meme stocks like GameC or GameStop. Most assets are being pushed up by speculation right now, and with inflation coming, it is going to act like a needle that pops the inflated balloon of the market. So that is a summary of Burry's basic position. But why then did he exit his short position on Tesla and ARK? And what should we be doing in response to his predictions? Well, as far as Burry being short Tesla via puts, Burry says that was only a short-term trade, and he never intended to put a flag in the ground against Tesla. Though he does believe the company is fundamentally overvalued in the long term, calling its $800 billion valuation from a few months ago ridiculous, and it's only gone up in value since then. So Burry clearly still believes the market is overvaluing stocks right now, and coming inflation is one metric we can look at to support that belief. But there are other hard numbers we can look at as well. One common way to value a company is its price to earnings ratio, or PE ratio, which you can calculate by dividing the value of the company by how much they earn each year. For a normal company, that might be anywhere from 12 to 15 if they aren't growing or shrinking. But if we look at the S&P 500 right now, the average PE ratio of the 500 largest companies in the US is 30, more than double the median PE ratio we've seen since the market started being tracked in the 1880s. Or we could look at the number of articles published talking about the market crashing. After all, we're not too far off the all-time high for the S&P 500 or even the NASDAQ. So let's break these down one at a time and talk about why selling all of your stocks right now would be a terrible option for most people. So starting with the PE ratio of the market being way higher than average. So that one metric alone might lead you to think that the market is overvalued, and it will revert to the mean when the prices of stocks drop. But that isn't necessarily true. See, everyone knows what the average PE ratio of the market should be. They know that, and yet they're willing to pay more for these stocks anyway. Well, why might that be? Well, some of the Fortune 500 are growing much faster than we've traditionally seen. Facebook, for example, is growing their revenue at 35% per year, which means if the price stays the same, their PE ratio will naturally drop from the earnings increasing. So yes, the price could drop to bring the PE ratio down, but the companies could also just make more money in a year, which would also bring the PE ratio down. But what about all those articles talking about the market crashing? Isn't that an indication that we should maybe be a little bit worried? Well, in general, the news tends to release articles similar to what their peers are releasing. So if one outlet releases an article about a potential crash, several others are likely to do the same, and vice versa. Back in 2016, there were all these articles telling us to sell out of the market and that it was at an all-time high. Well, it's a lot higher today than it was then, and we're still seeing those same kinds of articles. And here's the problem with worrying about the market being at an all-time high in capital letters. 1 out of every 15 days in the market is an all-time high. That's just what happens when it goes up on average each year. But if you don't believe me, let's look at what would have happened if you had only invested during all-time highs in the past. Well, if you had invested in the Dow Jones Industrial Average only during all-time highs from 1915 through 2017, you would have made on average 9% in 1 year, 21% in 3 years, and 31.7% in 5 years, with a 70% chance of you making positive returns during any of those time periods following an all-time high. And now let's compare that to the risk of missing out on the market because we panic and sell out too early. Because there are only two options. Either we sell and avoid a crash, or we sell and we miss the run-up when the crash doesn't happen. Well, a Merrill Edge study compared the hypothetical returns of investing $1,000 into an S&P 500 index fund from 2009 until 2018 for the entire decade and missing out on the best 10 months or the 20 best months. So if you had just invested during that time, your $1,000 would now be worth $3,500. But if you had missed the 10 best months, you would have less than half of that at $1,500. And if you missed the 20 best months, you would have lost money and only had $950 left at the end. And if you had invested all of your money in 2007, right before the stock market crashed, which was basically the worst timing anyone could ever have, it turns out that as long as you held through the crash and the subsequent recovery, you would have made all your money back by 2012, and you would have tripled your money between then and now. So most of the time, you will lose money by trying to time the market by pulling your money out. But what if you see a trend in the data that shows that a crash could be coming, or someone like Michael Burry predicts there will be a crash? Well, while Michael Burry has correctly predicted past crashes, he's also predicted many crashes that never came about. Tesla is now worth over $1 trillion. The market cap is up substantially from when he first started calling out the company for being overvalued back in 2020. And of course, GameStop rose 5 times higher than Burry's sell point and is still higher today than when he sold out. Sure, he could still end up being right in the long term, but as John Maynard Keynes said, the stock market can remain irrational longer than you can remain solvent. And if we look at the last major crash that we saw in the market, back in 2020 at the start of the pandemic, according to the annual Guaranteed Lifetime Income Study by Greenwald & Associates and Canex, just 11% of people with $100,000 or more invested thought that a market downturn was likely in 2020. And advisors did even worse, with just 6% of advisors with $15 million or more in assets under management anticipating any kind of downturn in 2020. So looking to others for your market crash predictions is generally not a winning strategy, which means our last bastion of hope would be to find some kind of unbiased metric or chart which we can look at to predict where the market will go next, like some kind of macroeconomic technical analysis. Up until recently, a commonly used predictor of future stock market performance was the inflation-adjusted interest rates on US bonds. In the past, if a US bond provided a negative interest rate, it predicted that stocks would either be flat or down over the next 5 years. And that held true for a very long time, until suddenly it didn't. Interest rates turned negative back in June 2020, and the market has absolutely exploded in value since then. This is kind of an anecdotal example, but it shows the problem with fitting statistics to data. Correlation does not equal causation. One of my favorite examples of a fake market metric was the Tiger Woods Bears and Bulls Index. This was an index that tracked Tiger Woods' performance in tournaments against the Dow, and over a 15-year period, it almost perfectly predicted the market, including the crash of 2008. So did that mean Tiger Woods' performance was somehow tied to the Dow? No, but if you look at enough data and try to make it fit, eventually you'll find a metric that proves whatever point you want to believe about where the market is going. So my strategy for this coming year is to keep my money invested in the market. If the market rises, I'll make some money. If it drops, I'll be able to buy more stocks at a cheaper price. And I know that on average, I will make more money staying invested. While Burry did great calling the start of the Great Recession, a lot of people sold out after the crash at the bottom and then never re-entered the market. And those people are going to have a very hard time ever becoming wealthy or retiring after missing out on the huge bull market run that we've seen. But speaking of returns, if you sign up for WeBull and deposit money into your account, you will get 2 free stocks worth all the way up to $2,400. Don't forget to like and subscribe, and I'll see you next time.